we talk about in this class, other than the introduction and classification, is going to be formation of the partnership. So sort of a lifestyle of the partnership. We start at the very beginning, and we deal with how does the partnership get formed. Well, people, the partners contribute usually cash or property or services to the partnership and get back a partnership interest. So we're going to focus today on the contribution of cash and property. We'll deal with the contribution of services, which is kind of trickier later on. So to start, we're going to spend a few minutes in the code book looking at some code sections. So if you can get that handy, I will share my screen. We're going to start with section 1001 of the code. And this 1001 of the code should be familiar to all of you. It was a code section that comes up very frequently in the basic federal income tax class. And it tells us in 1001A, right here, it says the gain from the sale or other disposition of property. So the gain from the sale or exchange or other disposition of property, and it tells you how to calculate it. It tells you that you figure out the amount realized over your adjusted basis in the property that you're giving up, and that gives you gain or loss realized. And then when you go down to 1001C, tells us, except that otherwise provided in the subtitle, the general rule is the entire amount of the gain or loss realized shall be recognized. And we know from Tax 1 that gain that is recognized is included in gross income unless there's an exclusion that applies. And a loss that is recognized may be deductible under 165 of the code. If it's investment property or property used in a trade or business, you can take a loss deduction. If it's personal use property, you recall, then you generally don't get a loss deduction. But we basically take into account gains and losses that are recognized. And in general, the default rule is that gains and losses on the exchange of property are recognized, but there's some exceptions. And so we're gonna, and one big one deals with partnerships, which is we're gonna cover. So this is the context that the rules we're gonna talk about today are exceptions and departures from the general rule that says when you swap property, you give up land to get back a partnership interest, an interest in an LLC, an interest in a general partnership or a limited partnership, any entity that's taxed as a partnership for federal tax purposes. That's an exchange of property. And absent a special rule, 1001C would have that gain or loss be recognized. And that would be a problem. I mean, so think about the policy rule, policy justification for the rules we're going to talk about, which turn the general rule on its head. The general idea here is that, well, we don't really want to cause a gain recognition when you contribute property to a partnership, because that would discourage people from coming together and forming partnerships, and we don't want to discourage that. Again, even taking it back further, if I buy property and it appreciates in value in my hands and I just hold on to it, I don't recognize any gain because I haven't realized any gain. We haven't had a realization event. So there's an incentive for me when I have a highly appreciated property to just sit on it and not do anything with it. Well, one thing I might think about doing with it is to contribute to a partnership so as to make it more valuable, right? Basically, make it something bigger. And under the general rule, I would have to pay a tax because that would be a realization event that would trigger gain. I would have to pay a tax. It would be a toll charge, if you will, for me to contribute the property to a partnership. So Congress took away this toll charge under Section 721. So let's turn there next. Section 721 is an exception to 1001C. Section 721 of the code says very simply, no gain or loss shall be recognized to the partnership which is not surprising. It's hard to think about the partnership having gain, but you might think about it a little bit. But generally, we don't tax entities when they receive capital contributions. But more significantly is, or to any of its partners, when property is contributed in exchange for an interest in the partnership. So there you go, no gain or loss recognized. So you contribute that appreciated property into the partnership. Technically, you would realize the gain, but 721 would say the gain is not recognized. And because it's not recognized, it doesn't get included in your gross income. Now, there's some exceptions for an investment company that we're not going to have to worry about. Very rarely would it apply. So this is pretty easy rule. No gain or loss recognized. And it's a nice rule for partnerships. Let's just take a little detour into corporate for a second. So let's turn just quickly to section 351 of the code. Section 351 of the code. We see a similar rule. This is in subchapter C, dealing with corporations. And I know a few of you are in my corporate tax class, so we'll be talking about 351 in a lot of depth later this afternoon. But just a comparison, it says no gain or loss shall be recognized. Same type of thing if property is contributed to a corporation by one or more persons solely in exchange for stock. But we have this condition: immediately after the exchange, such person or persons are in control. So for corporate tax, when you contribute property to a corporation, you have a non-recognition rule, but it's contingent on the property transferors being in control of the corporation. And control is defined later on to be 80% or more of the corporation. That's usually not a problem for the initial formation of the corporation, because it's all sort of done at once. You know, all the people contributing stuff all at once, it all goes in, and they're all in control. But what it really becomes a problem is what we call midstream contribution. So let's say the corporation's already going on for a while, and then somebody has property and says, hey, this could be useful to you. Why don't I contribute it and give me stock? Well, that's not going to work in a corporate. You could do it, but in a corporate regime, you're going to have gain recognition because you're not going to have control by the property transferors. The property transferor is only this one guy. You don't count the initial transferors because that's old and cold, and you have gain. But in a partnership, go back to 721, just for emphasis here, section 721, there is no control requirement. Doesn't say anything about having to be in control. So it's a really simple rule, and where the rubber hits the road here, where it really helps partnerships over corporations in this context, is what we call midstream contributions. If you got a partnership that's ongoing, some new guy comes around, wants to contribute property, appreciated property, he can do it to a partnership. But if that entity were a corporation, you would unlikely be able to do it without recognizing gain. Okay, any questions on 721? Well, now that we have no gain recognition, we then have to deal with basis consequences. And going back to the general rule in 1001, generally we'd have gain or loss recognized in an exchange of property. So if I exchange appreciated property for new property, I would recognize gain, pay tax on that gain. My basis in the new property would be a fair market value basis, because I've sort of popped out all the gain. So I take basically I have a new slate from a tax perspective. I get a fair market value basis under section 1012. It's cost basis. Well, we can't do that really with 721. We have non-recognition. That would allow gain to evaporate. So if I could contribute property to a partnership and then have there be fair market value bases all around, then that gain would just go away, and that's too good of a deal. That would encourage people to contribute property to partnerships. Congress was worried about discouraging. That would affirmatively encourage it. It would be a way to sort of get rid of gain, whitewash gain. That would be bad. So the code works hard to preserve the gain, the built-in gain. And so let's look at section 722 right down below. 722 deals with the basis of the contributing partner's interest. This is the contributing partner's interest in the partnership. So a partner's interest in the partnership. And we're going to use a term here, and you might want to annotate your code here. We're going to use the term outside basis to refer to a partner's basis in its partnership interest. Outside basis. We're going to contrast that with inside basis. Inside basis is the partnership's basis in its property. So you'll get familiar with this term because we'll only use those terms probably like 1,000 times over the next months. But that's the idea, outside basis and inside basis. And 722 is telling you what the outside basis of the partnership is upon a contribution of property. And it says quite simply the outside basis, the basis of an interest in a partnership acquired by a corporate contribution shall be the same as the amount of money in the adjusted basis of such property. So it's just a carryover basis. Whatever your basis was in what you contributed, that becomes your basis in your partnership interest, your outside basis. Money has a basis equal to face value, and so it's not an exception. The money rule is not an exception. It's just a specific example of whatever basis you had in the stuff you contributed. That becomes your basis in the partnership interest that you hold. And that preserves the built-in gain or loss. Whatever built-in gain or loss you had in the asset that you contributed, you have the same built-in gain or loss in the partnership interest that you own. So if you were to sell the partnership interest the next day, you would recognize a gain or loss. And then 723 deals with inside basis, and it's the same principle. The basis of property contributed to a partnership by a partner shall be the adjusted basis of such property. Increased by the amount of a gain, recognized under 721B. Again, 721B rarely applies, and we don't cover it in this class, and so it's just a carryover basis again, or whatever the basis of the property is in the contributor's hands, that becomes the partnership's inside basis. And that preserves the built-in gain of the asset. So if the asset had $100 of built-in gain before it was contributed, in the partnership's hands, it has $100 of built-in gain. You might think, that we duplicated this loss because we have a built-in gain in the partnership's hand and we have built-in gain in the partner's hands. That gets solved. Don't worry about that. It ends up not being the case in the partnership context. So when you put these rules together, 721 and 722 and 723, it tells you that this gain, this non-recognition is a deferral rule. It's saying, okay, we're not going to tax you now when you contribute this property, appreciated property, let's say. That's usually how it's done. When you contribute this appreciated property to a partnership, we're not going to tax you on that now, but we're also going to not let the gain evaporate into thin air. We're going to preserve the built-in gain through basis amounts. Any questions on 721 through 723? Okay, let's take a couple more code sections. Turn to section 1223. 1223 of the code. 1223. This deals with holding period. Now remember, to have, back to tax 1, to have a capital gain tax at preferential rates, it has to be a long-term capital gain. You have to have held the capital asset for more than a year. For business property, section 1231 provides beneficial treatment. for 1231 property, business property, but only if it's been held for more than a year. So the code has these year-long minimum holding periods for certain preferences. So one question, in a taxable exchange that 1001C applies to, the holding periods start anew. So again, if I swap out property, I get, my new property has a holding period of 1 day on the first day I acquire it. Likewise, my exchanger, the counterparty, starts with a new holding period. But where gain or loss is not recognized, the code provides for tacked holding periods. And so 1221.3 says, in determining the period for which the taxpayer has held property received in an exchange, so in this case, if we're the contributor, we've received a partnership interest in exchange for other property, there shall be included the period for which he held the property exchanged. Again, you could rewrite this to make it a little more clear. There shall be included the period for which he held the property relinquished. Probably be a clearer way of saying that. If under this chapter, the property has, for purpose of determining gain or loss, the same basis. So here that applies. When I contribute property to a partnership, get back a partnership interest, the basis of my partnership interest is the same as the property that I gave up. There's another condition. The property that I give up has to be either a capital asset or property described in 1231. So let's say I held land as a capital asset, and I've held it for more than a year, and I contribute it to a partnership and get back a partnership interest. If I sell that partnership interest the next day, I would still have a long-term capital gain because my holding period is long-term because of this tacked holding period, this tacked rule. Now, if I have an ordinary asset that I contribute, like inventory, then I don't get a tacked holding period because you don't get a preferential treatment for holding inventory for a certain period of time. What about the partnership's holding period? Well, 1223.2 deals with that. It says, in determining the period for which the taxpayer has held property, however acquired, there shall be included the period for which such property was held by another person. That's the contributor, the partner. If under this chapter such property has, for determining gain or loss in the sale exchange, the same basis in whole or in part. And because of 723, that applies in the partnership context. So the partnership would take a tacked holding period in whatever property it gets. Now, it's only meaningful for partnership property that's a capital asset or a 1231 asset. So if partnership gets inventory, technically there's a tacked holding period, but nobody cares because there's no holding period issue for ordinary assets. Okay, so contribution to property, it's pretty straightforward. No gain or loss to the contributor or the partnership. Contributor takes a carryover basis in its outside basis as its outside basis in the partnership. The partnership takes a carryover basis for the assets, and the holding periods are tacked generally all around, with the exception that the partner contributes assets other than capital assets or 1231, then there's no tacked holding period. So partner contributes cash or an ordinary asset that would be neither 1221. 1221, you recall, is a capital asset, generally property held for investment, and 1231 property is property used in trade or business. Okay, I'll stop. Any questions? Issues here? Anything I can clarify? Okay, well, the last part I want to talk about is a little trickier, which deals with this built-in gain. So now we've contributed this property. Well, let me do an example first. So simple example here. All right, simple example here. We've got two partners, A, who owns Blackacre. So A is going to contribute Blackacre. It's got a fair market value of 100 and adjusted basis in A's hands of 20. And B is going to contribute cash of 100. So I'm going to drop that down into this, let's call it an LLC. And they're each going to get back 1 unit of the LLC. So they're going to own 50% each of the LLC. So A contributes to Blackacre. It's 1 unit. B contributes to cash. Gets back 1 unit. And Blackacre ends up, the LLC ends up holding Blackacre and the cash. And of course, the Blackacre has a fair market value of 100. Cash is of 100. Each unit is worth 100. And so the question is, what are the tax consequences, and what's the basis? So A is receiving, technically we would say, okay, A has an exchange of property, giving up Blackacre and getting back this partnership unit. So A's amount realized is 100. A's adjusted basis in Blackacre is 20. A has 80 of gain realized under 1001A. But 721 says not recognized. So A has no gain recognized, right? Under 721. What is A's outside basis? Well, A's outside basis is going to be whatever his basis is in the partnership interest. So A is going to take an outside basis of 20. And what's the LLC's basis in Blackacre? That's going to be 20 under 723. So 80 of built-in gain is not recognized, and it's preserved in A's low outside basis and the LLC's low outside basis in Blackacre. B, of course, has no gain realized at all, right? Because there's no gain inherent in cash. And so B takes, and B's outside basis is going to be 100. That's the basis of the property contributed. A would get a taxed holding period in this partnership interest because assuming Blackacre is capital asset or a 1231 asset, it would be a taxed holding period. LLC has a taxed holding period in Blackacre. B has no taxed holding period because he's not contributing a capital asset or a 1231 asset. And again, if the LLC were to sell Blackacre, the LLC would recognize 80 of gain. If A were to sell his partnership interest, A would recognize 80 of gain. Okay, so that's all a review of what we just covered in a simple example. The question I want to deal with now is, well, what happens when if LLC were to sell Blackacre? What if LLC were to eventually sell Blackacre, let's say for $120 cash? So down the road, Blackacre is sold for $120. So now when it's sold for $120, we have an amount realized of $120. The basis of Blackacre is 20. So Blackacre has 100 of gain. Realized, recognized, there's no non-recognition rule for a sale for cash. and is included in gross income. So it becomes an item of gross income, 100 of gross income. The question now is, how is that gross income allocated to the partners? We know the partnership doesn't pay tax on that 100 of gain. The partnership's not going to pay tax on it. That 100 of gain is going to be allocated to the partners. How is it going to be allocated? And you might think instinctively that, well, since A and B each own 50%, this is a very straightforward sharing arrangement between A and B. They each own 1 unit out of 2 outstanding, that 50% of the gain would go to A and 50% of the gain would go to B. So 50 of gain to each of A and B. And that would be the case if this were an S corporation. There's no nuance in the S corp, it's simple. But in partnership, we try to be more precise. And in partnership, we say something like, well, of that 100 of gain, 80 of that was built-in gain that was A's gain when A contributed the property. That's A's pre-contribution gain. And we don't want to shift that to B. That shouldn't be shifted. Again, we don't want to discourage A from contributing the property to partnership. We don't want the gain to go away entirely. And we also don't want the gain to be shiftable to other partners. If the gain were shiftable to other partners, that pre-contribution gain were shiftable to other partners, there are a couple of bad things would happen. One is this could be ripe for tax abuse, that people could come together. Let's say B has capital loss carry forwards. And B could say, hey, A, why don't you, contribute this to the partnership, and, then you could shift a bunch of these gains over to me. And, I'll exact my pound of flesh somehow, but I'll basically use my capital losses to offset your gain. Or B could be in a net operating loss position where B isn't really worrying about taxes. B is like Uber. Uber's got billions and billions of dollars of losses. It's going to take years and years for it to eat away. So Uber could become what they call an accommodation partner that's sort of just there to sort of eat up the gain. Another bad thing would be, even if B is taxable, it doesn't have NOL as a capital loss carry forward, B would have to price into the deal the fact that B could get shifted some of A's gain, right? So even if there's no tax abuse, it makes things complicated if B could get shifted this gain. Basically, B gets a tax penalty and A gets a tax windfall. And that would have to be, if B were thinking well advised, B would have to price that into his deal and consider that effect. But under the partnership tax rules, and we'll see this in much greater detail later on, we're sort of foreshadowing, what ends up happening is that of this 100 gain, the 80 pre-contribution gain, the 80 built-in gain at the time of contribution goes to A. And the 20 post-contribution gain that split 50-50, 10 to A and 10 to B. And this rule that says that 80 goes to A, even though they're equal partners, this rule is found in 704C. We're going to take a look at that. So that's the rule 704C, which says that this built-in gain or loss that's preserved through 721 and 722 and 723 is going to eventually be allocated to the contributing partner and not shifted over to other partners. So these rules in combination do, defer the gain or loss and then properly allocate it to the partner who contributed the property with the built-in gain or loss. So that means A is not going to be able to avoid that gain, right? That's the idea, that basically A is not going to be able to avoid that gain. The gain is there. It's not going to be shiftable to other partners. Now, there is one way that A could avoid the gain. Anybody have a guess at one way that A could avoid this gain? Wild guesses. Okay, I see. So somebody, yeah. So John says testamentary. So leave it testamentary. Well, really, just it gets at it. It's like you don't really, yeah. You die with it. If A dies with a partnership interest, we know from tax 1. So one way to think is that death solves a lot of tax problems, and not just because the taxpayer is dead, but even to the heirs, tax problems are solved. If A were to die with the partnership interest, A would get a stepped up basis in the partnership interest to fair market value under section 1014, as you might recall from tax 1. So A's outside basis would step up to 100. And if a certain election is in effect, a 754 election, we'll talk about 754 elections quite a bit later on, then that is going to also step up the basis, the partnership's basis in Blackacre. So when I say A can't avoid the gain, it's really not true. A can avoid it by dying. But other than that, the gain is going to be generally going to be stuck to A. And 704C does a bunch of that work. Let's take a quick look at that here. 704C. So take a look at 704C of the code. Well, let's start with 704A. 704A, and we're going to spend a lot of time in 704, so don't worry if this is a little bit oblique at this point. A partner's distributive share. That's another way of saying allocation. I like to use the word allocation instead of distributive share. Distributive share sort of implies that there's some distribution that has to happen, and it's not the case that a distribution has to happen anytime soon, but they're used interchangeably. So a partner's allocation of income, gain, loss, deduction, or credit, so those are allocations of tax items, shall, except as others provided, be determined by the partnership agreement. So our general rule is that how is that gain from the sale of Blackacre allocated? It's generally determined by the partnership agreement. So the partnership agreement could say all gains and losses are allocated 50% to each. But there's this except as otherwise provided in this chapter. So the general rule is the partners get to choose how gains or losses are allocated. 704C is a limitation on that electivity. And 704C says income, gain, loss, or deduction with respect to property contributed to the partnership by a partner shall be shared among the partners so as to take into account the variation between the basis of the property contributed and its fair market value. Again, there are more detailed rules, but that's what says in our example that 80 of built-in gain, when A contributes, is eventually allocated to A when that Blackacre is sold for 120. So that's what says that 80 of that 100 of gain, 80 that comes off the top and goes straight to A as a contributor of Blackacre, and the other 20 then are allocated under the general rule, which is 50-50 per their agreement. Okay, any questions on any of that? Okay, well now changing gears, we're going to talk about now partnership accounting, for lack of a better term. And one of the things that makes this class tricky is that we have to keep track of multiple accounts. And the accounts are similar in many ways, but not identical. Of course, if they were identical, we would have to keep track of multiple ones. So they're similar in many ways, so it's easy to get sort of confused about the accounts. And but then they're different in important ways. And so we're going to talk about two of these accounts. Now, we've already talked about one, outside basis. We're going to talk more about outside basis now. But the other account is known as a capital account. So we're going to talk about capital accounts and outside basis accounts. And before we get to the details of capital accounts, let me talk about partnership balance sheet. So in many situations, we will ask you to determine a partnership's balance sheet as of the end. It could be after contribution of property, as of the end of year 1, as of the end of year 2, and so on. And so partnership balance sheet is going to have the partnership assets on the left. And sometimes the assets will be on top, but we'll do assets on the left. And for an asset, we're going to have the book value of the asset, book value, and we're going to have the adjusted basis of the asset in the partnership's hands, which is otherwise known as the inside basis. So for any asset of the partnership, it'll have a book value and an inside basis. Sometimes those will be the same. So if you have cash on the balance sheet, cash is going to have a book value equal to face and an inside basis equal to face. But many times, particularly with contributed property, we're going to have contributed property with a book value and inside basis. It's different. Like with Blackacre in our example before, when it was contributed, it had a book value of 100, the fair market value, and an inside basis of only 20. Then on the left-hand side, we have debt, partnership debt, and then we have partnership equity, which is known as capital accounts. And this is a fundamental accounting equation. Those of you that have taken some accounting courses, that assets have to equal liabilities plus equity. The balance sheet has to balance. The book value of your assets has to equal the sum of your debt and your capital accounts. It just has to happen. If your balance sheet doesn't balance, then you've done something wrong. So we're going to learn about partners' capital accounts now, or at least we're going to start learning about it. We'll spend a lot of time on capital accounts. The reason why capital accounts are important, it's kind of hard to explain at this point. We'll see that they come up time and time again in important ways, but they're important in terms of the allocations of tax items, 704A and 704B that we'll talk about. So just trust me for now that capital accounts become important. And that's why we're focusing on them. But the reason they're important won't become clear until a few more classes. So how do we determine the partnership's capital accounts? How do we keep track of what are the rules for capital accounts? Well, we're going to go into this reg now. I'm going to write it down because it's a long one. But if you want to know where the rules for capital accounts are, they're found in this regulation, 1.704-1B2, 4 little i's. And then we're going to start in B, which are the basic rules. So we're going to turn there right now. 1.704-1B2, 4 little i's, B. (1.704-1B2, 4 little i's, B). Right here on page 1601 in the volume, the code and reg volume that I'm using. This is CCH 2020-2021 version. The heading is basic rules. And so this is a starting point to determine how do we calculate someone's partner's capital account. And you can think of a capital account as kind of like a bank account. It's kind of like your bank account in your partnership, if you want. Well, your bank account goes up when you put money in. It goes down when you take money out. It goes up when you earn interest on your bank account. You really can't lose money in your bank account, right? But if you could lose money, let's say you had negative interest. So actually in like European countries, they have negative interest rates. And so if you were there, your bank account would go down when you earn negative interest. So you can think about your capital account as like your bank account interest in your partnership. And so here your capital account is increased. Your capital account goes up by the amount of money contributed, cash contributed. It's pretty straightforward. The fair market value of property contributed. Fair market value of property contributed. So that's why Blackacre, if you contribute Blackacre with a fair market value of 100 and a basis of 20, your capital account goes up by 100, not by 20. Your capital account goes up by allocations of partnership income and gain. So say your allocated income and gain, including tax-exempt income and gain. Then your capital account goes up. And then your capital account goes down, is decreased when by distributions of cash, down by the fair market value of property distributed to you by the partnership. These are allocations, base 6 and 7 are allocations of deductions and losses. Well, let's go back. 6 is allocations of non-deductible expenditures. So non-deductible expenditures, so things like bribes and government penalties, government fines and bribes are non-deductible. So these are non-deductible expenses. We'll talk some more about it, not that important here. But here are allocations of partnership loss and deduction. So you could allocate a loss or a deduction or a part of it. Your capital account goes down by that. It's floating down with those deductions and losses. It's representing your economic interest in the partnership. Goes up by the value of the stuff you contribute. Goes up by the allocations of income, gain that are allocated to you. It goes down by distributions of stuff to you, and goes down by allocations of losses and deductions to you. So those are your capital accounts. And there are some other more complicated rules that we'll talk about, but those are the basic stuff. Questions on the basic capital accounting rules? Okay, and then we've got, didn't want to do that. Then we've got outside basis. It's another account we have to keep track of. What's our basis in our partnership interest? So that your outside basis calculation is based on section 705 of the code. So turn to section 705 of the code. So these are the rules for calculating someone's outside basis. It says the adjusted basis of a partner's interest in a partnership. And again, it's a long-winded way of saying the outside basis shall be the base of such interest determined under section 722. That means a carryover basis from whatever you contributed. And then you increase it by your share, your allocations of income of the partnership, taxable income of the partnership, your share of tax-exempt income of the partnership. So the partnership recognizes, has municipal bond interest that's exempt from tax. You'll get allocated some of that tax-exempt municipal bond interest. You won't pay tax on it, but your outside basis will go up by it, just like your capital account goes up by it. We'll talk about why that is later on. You don't have to worry about depletion. Dealing with oil and gas, we won't have to worry about that. And then our outside basis goes down, but not below zero. No such thing as negative basis. So we've talked about a couple of things. Well, this is the second thing we've talked about, but if you come up with your balance sheet not balancing, you've done something wrong. If you come up with if your answer is somebody has a negative basis in anything, you're wrong. There's no such thing as negative basis. So your outside basis can't go below zero, but it's decreased by distributions by the partnership. And then reduced by losses of the partnership, deductions and losses, and these non-deductible expenses. We'll spend some more time on that later on. So those are our basic rules for outside basis. And you might look at it and say, well, that seems pretty similar to capital accounts. There's a lot of overlap between capital accounts and outside basis. For example, both go up by your allocations of income, whether taxable or exempt. And they both go down by your share of losses and non-deductible expenses. That's true. But there are a few things that can make them different. And we're going to talk about, I'll identify them now. So one is contributions of property. When you contribute property, your capital account goes up by the fair market value of the property, but your outside basis only goes up by the adjusted basis of the property, as we've seen. Likewise, for distributions of property, we're going to see later on that when property is distributed, your outside basis goes down by the basis of the property distributed, generally. Whereas for capital accounts, your capital account goes down by the fair market value of property distributed. So in dealing with contributions and distributions of property, the outside basis adjustments are all with respect to the adjusted basis of the property. The capital account adjustments are with respect to the fair market value of the property. So that's one difference, major difference, treatment of property contributions and distributions. Another difference, which is not as major and pretty easier to understand, is that your outside basis can never go below zero. You can't have a negative outside basis. Your capital account can go negative. Kind of like your bank account going negative, right? If you overdraw on your bank account, you'd have a negative bank account. Not a good thing, right? Because you then have to write a check or contribute money to the bank to bring you back up to zero. But there's no such thing as a negative outside basis, but your capital account can go negative. And then another difference is the treatment of partnership debt. So if you have debt in the partnership, so partnership debt, the partnership has borrowed money. We have some different treatment here. And for that, we need to take a look at section 752 of the code, 752 of the code. And by the way, just in case anybody's worried, like we're going to spend several class sessions on 752. We're going to spend several class sessions on 704, dealing with pre-contribution gain or loss. So we're going fast here, but nothing that we're doing today is going to be left. It's all going to be built upon. And so again, I can imagine that this is a lot of material, but we're going to keep building on it. So two things. One is don't be too concerned if you're not getting all of it. But also, it's important for you to work hard to get this, ground material, because it's going to make it easier for the rest of the course. I think I mentioned earlier, last class, this is tough stuff. So there's just no way anyone can learn this stuff effectively without just rolling up your sleeves and putting in the work. It's just, you can be brilliant and have a really good aptitude for tax, and without the work, It's just not going to happen. It's just too tough. So it's an encouragement to really try to work hard early in the semester. It'll pay off as you go through the material, but also not to panic that if you're not getting all the intricacies of 752, I wouldn't expect you to at this point, and we're going to spend a lot more time on it. But what does 752 do? And 752 says any increase in a partner's share of the liabilities of a partnership. So whenever a partner's share of the liabilities of a partnership go up, it shall be considered a contribution of money by such partner to the partnership. It's a constructive or deemed contribution of money by such partner to the partnership for tax purposes. So again, I would annotate here and put at the end for tax purposes. It doesn't have an impact for book purposes, for capital accounts. For capital accounts, book, those are sort of interchangeable. There's no deemed contribution of money for capital accounting purposes, for book purposes, only for tax purposes. So that means your outside basis goes up when your share of the partnership's debts go up, but your capital account doesn't go up when your share of the partnership debts go up. And the reason why is that debt's already accounted for on the right side of the balance sheet. So you have debt on the right side of the balance sheet. If you put debt on the right side of the balance sheet as debt, and then also in the capital accounts, you'd end up double counting the debt, and your balance sheet wouldn't balance. So let's see how these rules work. We have a example in the we have a problem in the casebook. Let me find that problem now. So this is the problem on page 50. No, not 50. Problem on page 48, I believe. Yeah. So this problem on 48, we've got A, B, and C, and they're forming ABC partnership. So what this asks us to do is construct the balance sheet after these events. And so we start out pretty simply. Again, we're going to have A contributes cash. So again, we're going to have our assets on the left, our debt on the right, and our equity on the right will be in the form of the capital accounts. And so when A contributes cash, we can put cash on the balance sheet, and cash is going to have a book value equal to face and an inside basis equal to face. A is contributing the cash, so A gets a capital account of 50, the amount of money contributed, and gets an outside basis of 50, the basis of the property contributed. By the way, I do this, I go left to right. I'm like I feel like I go book on the left side and then tax basis on the right. The textbook, I know, does it the other way. I feel like that's kind of like reading Hebrew, like right to left. But any way you want to do it is fine. So I've seen students do it different ways. And again, I'm not a stickler in an exam for exactly how you present the information. I will work hard to understand what you're doing, and as long as it's labeled, it can be presented anyway. This is the way that I like to present it, but feel free to do it other way. What about B? B is more interesting. B is contributing land number 1. It has a fair market value of 50 and a basis in B's hands of 40. So Under 723, land number one's inside basis is 40. Now, there's no rule that tells you what book value is. Like, you know, again, we talked about the capital accounting rules. We talked about 705 and 722 for outside basis. There's no rule I can point you to that tells you that land number one's book value is fair market value upon contribution. But it's implied by everything else. I mean, that has to be the rule. Otherwise, your balance sheets won't balance. So your book value, your starting book value of property is going to be the fair market value of the property when it's received by the partnership. So B's capital account goes up by 50, the fair market value of the land one. B's outside basis is 40, the basis of B in land one. And then C is also contributing property, but that property unusually has exactly fair market value is the same as basis. So basically it's kind of like if you buy, you know, publicly traded stock and then immediately contribute it to the partnership, it'll have the same basis as fair market value. So the securities will have a book value of 50 and an inside basis of 50. So that's at the end, you know, after the contributions, there's no debt. Let's do a check. Our balance sheet has to balance. So the combined book value, 50, 50, 50, that's 150, has to equal the combined debt, which is 0, and the combined capital accounts, which is 50, 50, and 50. So our balance sheet balances. We could also compare outside basis and inside basis. Our outside basis is 50, 40, and 50 for a total of 140. Our inside basis is 50, 40, and 50 for a total of 140. So that's typical for outside basis and inside basis to equal. It's not necessarily always the case. So while your balance sheet always has to balance, again, if it doesn't, you've done at least one thing wrong. If your inside basis and your outside basis in the aggregate aren't equal, that's not necessarily an indication you've done something wrong. Those sometimes go out of whack, as we'll see later in the course. Okay, any questions on the initial setup? Okay, first transaction is the partnership earns $15,000 of income, so rental income. And so that's 15,000 of cash income. So we know the cash is going to go up to 65. Just earned 15 of cash income. Now we have to allocate the income. This is just to indicate part A of the problem. So 15 of income, if this is a 3-person equal partnership, we allocate 15 divided by 3, 5 to each. So A, B, and C each get 5 of the income is allocated to them. And that has significance to them. They're going to report that on their tax return, 5 of income. And it's going to make their capital accounts go up and their outside basis go up, each by 5. Notice that even if there's no distributions, if that's all that happens this year and there are no distributions, A, B, and C still would have to pay tax on the 5. I mean, it gets allocated to them. Maybe it's sheltered by other deductions they have. But that would be a situation where there's so-called dry income, income that's allocated to you without liquidity, without cash. And it can happen in partnership because we tax you on your allocations, not your distributions. You can have allocations without distributions. You could have distributions without allocations, but here we have an allocation. And so to deal with this, partnerships typically have what's known as required minimum distributions that will say to the partnership that it's required to distribute at least some percentage of the income that's allocated to a partner each year to at least allow the partner to have the cash to pay the tax. So that's A. Let me just see. Sales of securities. So we sell the securities. Selling securities doesn't do a whole lot here. Because there's no gain. Nothing really happens with the securities. So we sell the securities. There's 50, we sell it for 50. There's no book gain and no tax gain because the book value and the tax basis are 50. So all that happens there is the securities come off the books and our cash goes up to 115. But there's no items to allocate. There's no book items or tax items to allocate because there's no book gain or loss or tax gain or loss. The next thing that happens is the partnership borrows $300, takes 30 of the cash, of its own cash, takes the 300 borrowed cash and buys land number 2 for 330. So buys land number 2 for 330. So the book value is 330 and the cost basis is 330. The cash goes down to 85. Okay. So now, now the partnership has debt. So the partnership's debt has gone up from 0 to 300. That means the partner's aggregate share of the debt has gone up from 0 to 300. And the only question now is, how do they share the debt? How do they share the debt? Let's assume that they share the debt 1/3 each, which would be the case under these facts. We'll talk more about sharing the debt later on. But assume it's 1/3 each. Each partner's share of the debt has therefore gone from 0 to 100. And under 752A, that's treated as a deemed contribution of money to the partnership. So that increases their outside basis by 100. It's under 752A. Notice that there is no capital account adjustment for that debt. So one common error that students make is they will also adjust the capital accounts by 100. And that's not right. 752 applies only for tax purposes. There is a reg provision that we'll go over next class that clarifies and makes clear that there's no adjustment for book for this. And we know that there's no adjustment for book because if we were to add up the left side of the balance sheet, the book value, we've got 465 over here total, 135, 465. We add up the debt and the capital accounts, we've got 465. If we put the capital account, the debt and the capital accounts as well, we'd have 765. We'd have, and it's because we would have double count the debt on the right side. It would be both in the debt and in the capital accounts. And so we know that that's not right to put the debt also in the capital accounts, but it does increase the outside basis. And we'll talk about more why that is later on. We'll spend more time on 752. Okay, then in C, there's going to be a distribution of 60 of cash. So the cash goes down to 25. And then we distribute cash. For capital accounts, we know when you get distributions of cash, your capital account goes down by the amount of cash distributed. And your outside basis goes down by the amount of cash distributed, but not below 0. We're not hitting the 0 limit. So we're going to also see later on that there's no tax upon the distribution of cash generally. So capital accounts and outside basis go down the same amount by 20. And then finally, in D, we're selling land 1. So land 1 ends up being sold for $65,000. So the land is being sold for 65. Whenever we have a sale of the property, we can calculate the book gain or loss and the tax gain or loss. We did that with the securities. There was no book gain or loss or tax gain or loss. But here, we can calculate the book gain. We take the amount realized of 65, put it over the book value of 50. 15 of book gain. And then for tax, we take the same amount realized of 65 and put it over our adjusted basis of 40. 25 of tax gain. So we have 15 of book gain and 25 of tax gain. We have to allocate. Now the book gain is pretty simple. We allocate it the way the partners have agreed, which would be 1/3, 1/3, 1/3. The 25 of tax gain is a little bit trickier, but remember when B contributed the property with 10 of built-in gain. So that 10 of built-in gain goes sort of off the top to B. So that 10 of built-in gain goes to B. The 15 of post-contribution gain, the property went from 50 to 65 while it was held by the partnership. That post-contribution gain is shared equally between A, B, and C. So at the end of the day, B gets allocated 15 of tax gain, his 10 pre-contribution gain, and his 5 share of post-contribution gain. And A and C are allocated 5 of post-contribution gain. And so now land 1 is off the books. And now we have 90 of cash. Cash goes from 25 to 90. So we can add this all up. Here, let's see, sum everything together, do some checks to make sure we haven't screwed anything up. So our capital accounts are 40. Our outside basis is each 140. So our left side of our balance sheet is 90 of cash plus 330 of book value for number 2. That's 420. Our right side of the balance sheet is 300 of debt and 40 of capital account. So our balance sheet balances, thank goodness. Our aggregate inside basis is also 420. And our aggregate outside basis is 420, which again, that is commonly the case, but not always. And we no longer have any book tax disparity here. We've resolved that with B. The reason why our capital accounts and outside bases are different is because of the debt went in the outside basis, but not in the capital accounts. Recognize that for B, before we got to D, transaction D, B's capital account outside basis was different for 2 reasons. One is he got 50 of capital account for the contribution of land 1, but only 40 of outside basis. And then B also, like A and C, got 100 of outside basis credit, but no capital account credit for the share of the debt. Any questions on any of this? Like I said, I know this is a lot of stuff, a lot of code sections, a lot of numbers going all around. I encourage you to, one of the good things about this class being online is that you have the opportunity to go back and listen. And I've heard when I've taught this class and where it is recorded, I've heard the students like that. And so that's good. I encourage you again to spend the time up front on this class and not get too far behind in terms of understanding the material, because we only keep building, right? We're building and building on this stuff. So again, don't worry too much if it's tough, because it is. But also I'm encouraging you to work hard early on to get your feet underneath you. Any questions? Okay, so we're on to the next topic, next class, and that's going to be contributions of encumbered property. So we've dealt with now contributions of property that's not subject to a debt. We're going to deal with next situation. What happens if a partner contributes property and it's subject to debt that the partnership assumes? We're going to see that that picks up on what we've talked about. So we'll talk, again, a good chance to go over this stuff again, but it only gets sort of tougher. Okay. Questions? All right. Well, that's the end of our time.